I want to show you how to set the bid price. So the question is, how much should a company bid for a contract? Governments usually require contracts to go through a bidding process. Private companies will usually use a bidding process to try and find the best price for the services they want. So the goal of the company bidding for the contract is to bid a price that will provide a fair rate of return. If you bid too high a price, you're not likely to get the contract. If you bid too low a price, you're going to earn a return that is not commensurate with the risk you're taking. So we can use NPV to work this out. When NPV is equal to 0, the project earns the fair return for its level of risk. So what are the steps? Basically, you find the operating cash flow that will result in the project having an NPV equal to 0, and then you work backwards to find the price that will give us these operating cash flows. So I think it'll be clearer if we look at a numerical example. The town of Fairtreat is looking to purchase 5 handicap accessible vans per year for 4 years. Mobility Partners, Inc. modifies vans to make them accessible for individuals with disabilities. What price should MPI bid for each van? So we need to know a little bit of information here. Let's assume that the equipment for the work is going to cost $200,000, that MPI is going to have to make an investment in net working capital of $75,000. So that would be inventories, accounts payable, accounts receivable, etc. The total cost per year to modify 5 vans equals $150,000. We're going to assume that they use straight line depreciation for 4 years with 0 salvage value. The tax rate is 21%. At the end of year 4, they're going to sell the equipment for $45,000. And the weighted average cost of capital, or the fair return they're looking for, is 20%. So the depreciation is just going to be the cost of the equipment minus the salvage value they're depreciating it to, which in this case is 0, divided by its useful life of 4, so we get $50,000 a year. The after-tax salvage value is going to be the selling price minus the tax rate times the difference between the selling price and the book value. This would be the capital gains. It turns out that the book value is equal to 0, so it's really all capital gains. So it's going to be $45,000 times 1 minus the tax rate, or $35,550. So here's what the cash flows look like. You're going to have these operating cash flows for 4 years. In year 0, you're going to invest $75,000 in net working capital, but we assume that in year 4, you recoup the net working capital. The accounts payable are paid off, the accounts receivable, you've been paid for, the inventory has been used and sold, etc. Capital spending is $200,000 in year 0, and you're selling the piece of equipment and receiving $35,550 after taxes. So you have these operating cash flows for 3 years, actually 4 years, plus in year 4 you get the $75,000 plus the $35,550, or another $110,550. If we take the present value of the after-tax salvage and net working capital and add it to the cost in year 0, we can figure out what the cost will be in present value terms in year 0. So the first thing we do is we find the present value of that $110,550. That is the net working capital and the after-tax salvage value, right? We discount it back by the 20% for 4 periods. We get $53,313. The cost in year 0 is now minus $275,000 plus this present value, which is a cash inflow of $53,313. So it's $221,687. So now our cash flow diagram looks like this: minus $221,687 and then we have some operating cash flows for 4 years. Now the OCF is an annuity, so we can solve for it. If you're using a financial calculator, n equals 4, the interest rate is 20%. The present value is 221,687, actually negative 221,687. And when we compute the payment, we get the operating cash flow of 85,635. If there's no interest expense, then we know that operating cash flow equals net income plus depreciation. Solving for net income, we get net income equals operating cash flow minus depreciation. So if we do that, we get that the net income we need is 35,635. So we want to find the level of annual sales that's consistent with net income of 35,635. The income statement looks like this. We have sales minus costs minus depreciation minus taxes minus net income. So we need to figure out sales and taxes. Well, we know that net income equals sales minus costs minus depreciation times 1 minus the tax rate. If we solve for sales, we're going to get this right here. We're going to have net income divided by 1 minus the tax rate minus the cost minus the depreciation times 1 minus the tax rate. We're going to get that sales each year have to be 245,108. And since we're selling 5 vans, that means we need to sell each van for $49,022. So they might just round up to 50 or maybe 49,500. But this is the price they need to charge per van so that they earn 20%. If they decide to round up a little bit, then they'll earn a little bit more than the 20% cost of capital. So I hope you found this useful, and thanks for watching.